Welcome to the Pro Ticker Deep Dive.
Glad to be here for this one.
Okay, let's unpack this. Today, we are setting out on a very specific mission. We are going to deconstruct, analyze, and structurally reverse engineer one of the most audacious financial experiments in modern corporate history.
Truly, it's wild.
It really is. We are looking at a publicly traded company that is attempting to functionally corner the market on a major decentralized cryptocurrency. I mean, they are operating less like a traditional corporate entity focused on, quarterly earnings and more like a digital nation state aggressively expanding its sovereign reserves.
Yeah, it's a fundamental paradigm shift in Treasury management. We're tracking numbers and capital allocation strategies that, frankly, they just shatter the conventional frameworks of corporate finance.
Right.
The scale of the capital being deployed here, the aggressive financial engineering being utilized to fund it, and the global macroeconomic forces converging on this single ticker. It's just unprecedented.
And I want to speak directly to you, the listener, right now. Whether you are managing a traditional equities portfolio or tracking macroeconomic liquidity flows, or maybe you're deeply embedded in the Web3 ecosystem analyzing on-chain data, this matters to you.
Absolutely.
It matters because what we are going to explore today represents a seismic disruption in how modern corporations leverage capital markets, how they basically weaponize their own equity, and ultimately how the very concept of value and reserves is being redefined right now in 2026.
We've clearly moved past that conservative era, right? Where a corporate treasury's primary function was just capital preservation. Holding cash equivalents, commercial paper, maybe short-duration government yields.
Right, the boring stuff.
Exactly. We are now entering an environment where public companies are actively utilizing their public float to absorb and hoard the foundational layers of decentralized digital networks.
Yeah. So let's dive straight into the mechanics of the company at the center of this. We are examining Bitmine Immersion Technologies. Their ticker symbol is BMNR.
BMNR. Now, for those tracking the crypto equity sector over the last few years, you likely remember them as a relatively standard mid-tier Bitcoin mining operation.
Yeah, they were running heavy, capital-intensive proof-of-work facilities down in Texas.
Texas, yeah. And Trinidad, I think.
And Trinidad, right. But they've executed a massive structural pivot. They've essentially abandoned that proof-of-work grind to transform into the world's largest Ethereum treasury company.
It's a complete metamorphosis of their business model. They didn't just diversify their balance sheet. They engineered a pure-play digital asset treasury, a DATE.
To really understand the sheer gravity of this market capture, we need to look at the verifiable on-chain data and their corporate filings. As of March 2026, Bitmine currently controls a hoard of 4.53 million Ethereum tokens.
4.53 million tokens.
Yeah.
At the current market valuation of roughly, what, $1,900?
About $1,965 per ETH.
Right. $1,965 per token. We are looking at a pure Ethereum position approaching $8.9 billion.
It's massive. But their total net asset value, their NAV, is actually sitting at $10.3 billion. Because that includes a $1.2 billion operational cash buffer, a legacy stack of about 195 Bitcoin they haven't liquidated yet, and some highly strategic private equity investments that we are going to tear into later.
And what's fascinating here is the sheer audacity of their public mandate. That 4.53 million figure is not an arbitrary accumulation point.
No.
Bitmine operates under a stated, aggressive accumulation strategy. They've literally branded the alchemy of 5%.
The alchemy of 5%, it sounds like a Bond villain plot.
It really does. Their terminal objective is to acquire and hold exactly 5% of the entire global circulating supply of Ethereum.
Wow.
And given that the current global supply sits at approximately 120.7 million tokens, their current hoard represents about 3.76% of all the Ethereum in existence. So they're systematically closing in on that 5% milestone.
But accumulating 3.76% of a $230 billion global asset class requires astronomical liquidity. I mean, accumulating a dormant asset on a balance sheet is what Strategy Inc. ticker MSTR does with Bitcoin. Strategy holds over 720,000 Bitcoin.
Right. And their playbook is well understood by the market now. Issue convertible debt, buy the Bitcoin, watch the NAV rise.
Exactly. But Bitmine's approach with Ethereum utilizes different mechanics and carries vastly different structural implications for its shareholders. The pressing question is the funding mechanism. How are they paying for this?
Yeah.
Bitmine is essentially operating an ATM on the open market. They are aggressively issuing new stock to raise the capital to buy the crypto.
Which brings us to the recent shareholder vote. And this vote fundamentally alters the capital structure of the company. The board authorized an increase in their common shares from 500 million to 50 billion.
50 billion shares?
It is a staggering amount of potential dilution.
Let me stop you there, and just for you, listen, let's break down what that kind of dilution actually means. Think of the company's value like a pizza.
Okay.
You and the other shareholders own this pizza, and it's sliced into 500 million pieces. You hold your slice. Now the management comes in and says, we're going to slice this exact same pizza into 50 billion microscopic slices. And we're going to sell all those new tiny slices to buy a massive digital pizza.
It's a great analogy. While authorized shares aren't exactly the same as issued shares, meaning they haven't flooded the secondary market with all 50 billion of those tiny slices, yet it provides the executive team with the limitless ammunition required to execute this strategy.
Yes.
They are essentially utilizing their equity as a printing press, converting fiat-denominated stock into decentralized digital assets.
BitMine's board authorizing 50 billion shares is a weaponization of their equity. They're actively choosing hyper-dilution to front-run institutional Ethereum adoption. The gamble here is purely mathematical.
Exactly. Can their NAV accretion outpace the brutal reality of their expanding float?
That's the question. You are asking institutional and retail shareholders to absorb extreme equity dilution today, betting that the underlying Ethereum will appreciate so violently that the fractionalized value of their remaining microscopic pizza slices still yields a net positive return.
And that is the core structural tension of the BMNR trade. It requires a monumental leap of faith in both the macro trajectory of Ethereum and the disciplined execution of BitMine's management team.
Yeah.
Because think about it, you have a publicly traded corporate entity, heavily regulated by the SEC, actively trading on the NYSE American Exchange, and they are leveraging legacy fiat capital markets to aggressively centralize the supply of an open-source, decentralized protocol. It's an aggressive arbitrage between traditional financial frameworks and the Web3 settlement layer.
To truly grasp the risk profile of this arbitrage, we really have to analyze the architect driving the whole strategy.
Tom Lee.
Right. BitMine's chairman, Tom Lee. Now, Lee's background is deeply rooted in traditional finance. Formerly of J.P. Morgan, co-founder of Fundstrat Global Advisors.
He's a Wall Street veteran.
He is, and throughout his career, he has cultivated a reputation as a relentless, fearless permeable. He is the strategist who models massive upside potential and aggressive price targets. He often leads the market consensus during periods of high macroeconomic uncertainty.
And if we connect this to the bigger picture, Lee's justification for this specific pivot to Ethereum is built entirely on what he terms the digital oil thesis.
Digital oil. Let's dig into that.
In his framework, Ethereum has decoupled from the concept of mere digital money. Digital money is Bitcoin's primary narrative. Lee models Ethereum strictly as the foundational settlement layer of Wall Street.
Let's break down the mechanics of what a settlement layer actually is. The traditional financial system relies on a convoluted, high-friction architecture to clear and settle transactions. Moving capital, transferring the ownership rights of an asset, executing a complex derivative trade, all of that requires a multi-day settlement process.
T+1 or T+2 settlement.
Exactly. It involves clearinghouses, custodian banks, just a maze of intermediaries taking a cut. Lee's core argument is that the inevitability of traditional finance is total tokenization.
He is betting that all real-world assets, commercial real estate, sovereign bonds, private equity distributions, they will all eventually be represented as smart contracts on a blockchain.
Right.
But to execute this globally, across jurisdictional boundaries and competing banking cartels, traditional finance requires a neutral chain.
A neutral chain.
Yeah. They need a decentralized infrastructure that no single sovereign state or central bank can unilaterally censor or control. But it still needs to possess the cryptographic security required to settle trillions of dollars in daily volume instantly. Lee posits that Ethereum has already won the race to be that neutral chain.
And that is where the digital oil analogy crystallizes. Just as the physical industrial revolution of the 20th century required hydrocarbons' actual oil to power the combustion engines of global logistics,
This 21st century financial revolution requires digital oil.
Ethereum is the fuel. To execute these global tokenized transactions on the network, institutions must pay gas fees, and those fees are denominated in ETH.
Right.
So Lee's thesis is that as Wall Street migrates its operations on-chain, the institutional demand for ETH to power those daily transactions is going to create a massive supply shock.
And Lee contextualizes this technological migration within a very specific, historical, macroeconomic framework. He compares the current regulatory landscape we are observing right now in 2026 to August 15th, 1971.
1971, the Nixon shock.
Exactly. That was the day the United States executed the Nixon shock, unilaterally terminating the convertibility of the U.S. dollar into gold. It effectively ended the Bretton Woods system.
And the structural implications of 1971 were absolute. Prior to that date, the global financial system was anchored to physical gold via the dollar. By severing that peg, the U.S. ushered in the modern era of free-floating fiat currencies.
It structurally altered the velocity of money.
It did. It birthed the modern foreign exchange and derivatives markets, and it created the highly financialized Wall Street ecosystem we operate in today. Lee is looking at the current legislative environment, specifically noting the passage of the Genius Act and the SEC's Project Crypto, and he's drawing a direct parallel.
Right. And just to be absolutely clear to you, the listener, we are analyzing these legislative acts purely as structural market catalysts. We are not endorsing or taking any political stance on the regulatory environment.
Good clarification. We're strictly looking at the market mechanics.
Exactly. So the analytical takeaway from Lee's perspective is that these new regulatory frameworks provide the exact same structural unpegging as 1971. By providing ultimate regulatory clarity for digital assets in 2026, he argues the government is officially greenlighting the next financial era.
The green light.
Right. Lee projects that this regulatory catalyst will allow the crypto asset class to structurally outpace gold as the premier global reserve asset. He is modeling a scenario where regulatory clarity eliminates the fiduciary risk for megacap institutions. That opens the floodgates for trillions in institutional capital to pour into tokenized assets, all of which will be settling on the Ethereum network.
Because his macro model dictates this inevitability, his price targets for the underlying asset are incredibly aggressive. I mean, he is publicly modeling an Ethereum supercycle.
Oh, yeah.
He's projecting ETH to reach between $7,000 and $9,000 by early 2026. Furthermore, his terminal long-term valuation target sits at an astonishing $20,000 per token.
Those targets require a massive expansion of the current market capitalization. However, Lee isn't solely relying on a fundamental macro thesis. His models are heavily supported by technical analysis.
The DeMark data.
Yes, prominently featuring data from Tom DeMark of DeMark Analytics. DeMark's technical modeling is highlighting a severe, statistically significant historical parallel right now.
Yeah, the technical data DeMark is isolating shows that Ethereum's current price action exhibits an 89% to 93% correlation with the structural market crashes of the S&P 500 in 1987 and 2011.
Which is wild to think about.
It is. Both of those historical events were characterized by violent cascading liquidity vacuums, but they were followed immediately by aggressive V-shaped recoveries where the market aggressively repriced assets higher.
And DeMark's predictive models, utilizing this specific correlation, indicate that Ethereum was mathematically slated to establish a definitive structural bottom around $740 in mid-March of 2026. Okay. If the technical fractal holds, that bottom serves as the launch pad for the V-shaped supercycle Lee is predicting. This technical confluence is the exact justification BitMine is using to aggressively front-run the market.
They're timing the bottom.
They are diluting their equity to accumulate maximal ETH at these specific, technically validated entry points.
But buying the asset is only half the equation here. Accumulating a dormant asset and waiting for capital appreciation is a passive treasury strategy. Ethereum's fundamental architecture allows for active yield generation.
This is the separator.
Right. This is where BitMine's corporate strategy violently diverges from a company simply hoarding physical gold or Bitcoin. Ethereum operates on a proof-of-stake consensus mechanism which dramatically alters the capital efficiency of the asset.
What's fascinating here is how it changes treasury utilization. Under a proof-of-stake model, you don't just hold the asset, you deploy it. By locking your Ethereum into the network's smart contracts, you provide the cryptographic security required to validate global transactions.
And you get paid for that.
Exactly. In exchange for providing this security infrastructure, the protocol programmatically pays you a yield. And that yield is denominated in newly minted Ethereum and transaction fees. This is the mechanics of staking. BitMine has weaponized this feature at an institutional scale.
Looking at the on-chain data, out of their 4.53 million ETH hoard, BitMine has actively staked over 3 million tokens.
3 million.
That means roughly 67% of their total holdings are locked into the protocol, actively working as yield-generating capital. At current market valuations, that is a $6 billion capital deployment purely dedicated to securing the Ethereum network.
And the cash flow dynamics of this are just staggering. That $6 billion deployment is currently generating an annualized revenue stream of $174 million.
$174 million a year.
BitMine is essentially harvesting a massive organic yield directly from the protocol layer. They aren't monetizing a software product. They aren't managing physical supply chain logistics. They are extracting $174 million annually simply by providing the base layer security for the network.
And the performance metrics indicate they're executing this highly efficiently. The data confirms they are achieving a 7-day trailing yield of 2.91%. That actively outperforms the composite Ethereum staking rate, which is currently baseline at about 2.84%.
Right.
Generating positive alpha on a $6 billion staking position requires incredible operational sophistication.
The mechanism driving that outperformance is entirely proprietary. They are not outsourcing this $6 billion position to third-party validators or decentralized staking pools like Lido. BitMine is actively building their own native infrastructure.
They're building the pipes.
Exactly. They have targeted a Q1 2026 launch for a division they call Maven.
Maven, the Made in America Validator Network. That nomenclature is highly intentional. It carries significant geopolitical and regulatory weight. BitMine isn't just securing the network by running their own validator nodes through Maven. They are centralizing block production under an onshore, heavily regulated corporate umbrella.
And this is a critical evolution. By owning the bare metal hardware and the proprietary software that validates the network, BitMine transitions from a passive treasury holding an asset to a dominant, active participant dictating the flow of global decentralized finance.
Yeah.
It grants them absolute control over their security architecture, and it allows them to aggressively optimize their yield through advanced MEV strategies, maximal extractable value.
Squeezing every drop of profit out of the block building.
Exactly. Furthermore, the Made in America branding is a calculated beacon for risk-averse institutional capital. Major traditional finance players who want exposure to staking yields but are terrified of offshore regulatory ambiguity will look at Maven as the ultimate compliant onshore infrastructure provider.
It's a masterful narrative and infrastructural play. They are effectively wrapping the base layer of decentralized global finance in a compliant U.S.-regulated wrapper. But here's where it gets really interesting. While BitMine is aggressively building out this highly technical protocol-level infrastructure to dominate Ethereum block building, they are simultaneously executing massive capital deployments into sectors that, on the surface, seem completely disconnected from their core Web3 thesis.
Oh, the moonshots.
The moonshots.
We definitely have to analyze the moonshots. BitMine classifies these as strategic, high-growth equity investments entirely separate from their core Ethereum staking operations. And the most significant deployment here is a massive structural pivot into the creator economy.
We are looking at a $200 million direct equity stake. But it's not in a Layer 2 scaling solution or a decentralized exchange. It is a $200 million investment into Beast Industries, the corporate entity founded by Jimmy Donaldson, universally known as the YouTube megastar Mr. Beast.
Now, while it might sound like a frivolous media play to traditional analysts, the underlying mechanics of this deal are highly strategic. The scale of Beast Industries is unparalleled. They command a captive audience of 450 million global subscribers.
450 million.
And they generate over 5 billion monthly views across their ecosystem. They have essentially monopolized the attention economy of the younger demographics.
Let's map out how this actually works mechanically and why BitMine is deploying treasury capital here. The stated strategic goal is to force multiply decentralized finance DeFi with the global creator economy.
Right.
If Tom Lee's thesis is correct, and Ethereum is the inevitable settlement layer of the future, the critical variable is user acquisition. The Gen Z and Gen Alpha cohorts are digitally native. They do not possess the same inherent trust in legacy banking institutions as previous generations.
This is a massive, top-of-funnel customer acquisition strategy. Think about it. If Beast Industries decides to launch a global decentralized gaming ecosystem or a tokenized rewards program for 50 million concurrent viewers, they require a transaction layer capable of handling millions of microtransactions.
Instantly.
Yes. Traditional credit card rails cannot process sub-dollar transactions efficiently. The interchange fees would destroy the margins. By partnering with Bitmine, Beast Industries can natively route those microtransactions through Bitmine's Maven infrastructure on Ethereum. They'll pay fractions of a cent in gas fees, which Bitmine then captures. It is an infrastructural user acquisition play masquerading as a media sponsorship.
This aggressive diversification highlights a much broader defensive trend we are tracking across the entire crypto corporate landscape right now. These companies hold treasuries that are incredibly susceptible to violent drawdowns in the crypto markets. They are desperately hunting for robust, non-correlated revenue streams.
Yeah, look at a peer operator, Bitcoin Depot, ticker BTM.
Right.
Their core business is operating a network of Bitcoin ATMs. Yet they recently executed an acquisition of a peer-to-peer social betting platform called Cut.
If we connect this to the bigger picture, it exposes the structural vulnerability of operating a pure-play crypto business. The management teams at Bitcoin Depot and Bitmine understand that surviving a prolonged crypto winter, a multi-year bear market with suppressed network activity, requires diversified, counter-cyclical cash flows.
Exactly. Bitcoin Depot is pivoting capital into the $165 billion global wagering market. Bitmine is deploying capital to capture the creator economy. They are utilizing their highly volatile, crypto-native balance sheets to buy their way into adjacent cash-flowing sectors. They're building a financial moat to cushion the inevitable volatility of their core crypto holdings.
And that volatility is the exact reason we must aggressively pressure test this entire thesis. We have meticulously laid out Tom Lee's bullish macro model, the yield generation of Van, and the strategic moonshots. But a true deep dive demands rigorous friction.
We have to look at the other side.
We do. The institutional pushback against Bitmine's strategy is fierce. It's heavily capitalized and backed by deep on-chain forensic analysis. We must dissect the bear case.
Because the skepticism isn't just retail noise on social media. You have top-tier venture capital and aggressive short-selling syndicates actively deploying hundreds of millions of dollars, betting against the structural viability of this entire model.
One of the most vocal institutional critics is Andrew Kang from Mechanism Capital. He published a scathing takedown. He explicitly labeled Tom Lee's foundational Ethereum thesis as financially illiterate.
Financially illiterate. Those are fighting words in finance.
They really are. Kang doesn't just disagree with the price targets. He attacks the very core of the digital oil analogy.
Kang's counter-argument is deeply rooted in historical commodity pricing. He argues that framing Ethereum as a commodity like oil is a structurally flawed thesis if your objective is exponential price appreciation.
Right.
If you analyze the historical pricing data of real physical crude oil and adjust it for inflation, the asset has essentially been range-bound for a century. It experiences violent spikes during geopolitical supply shocks, sure, but it aggressively reverts to the mean. It does not possess the mechanics to 100x in value.
So the analogy falls apart.
Therefore, Kang models that if Ethereum's primary utility is simply as a commodity used to pay for computing power, market efficiency will dictate a natural hard ceiling to its valuation.
Kang's critique extends beyond just the commodity analogy, though. He attacks the actual on-chain data regarding utility. Lee argues that Ethereum is the undisputed settlement layer for stablecoins and real-world assets RWAs.
Yeah.
Kang counters by pointing directly at the volume metrics. He argues that the actual transactional volume for stablecoins and RWAs is aggressively migrating away from the Ethereum mainnet. He points to faster, higher throughput chains like Solana and Arbitrum capturing the microtransaction market.
And that's a measurable trend.
It is. Furthermore, he highlights that Tether, the dominant global stablecoin issuer, is actively deploying its own centralized chains. That is a strategic move specifically designed to route highly lucrative transaction volume entirely away from Ethereum.
This introduces a classic technological disruption debate. Kang's model positions Ethereum as legacy, first-generation technology that is actively being outmaneuvered by highly optimized application-specific networks.
The dinosaur in the room.
Exactly.
But
the institutional attack against Ethereum's dominance gets significantly more aggressive when we examine the short sellers.
this brings us to the Culper Research short report. This was not a passive critique. This was a highly coordinated, heavily capitalized short-selling campaign targeting both the Ethereum network tokenomics and BMNR equity directly.
Right.
Culper Research took a massive directional bet that the underlying economics of both assets are fundamentally broken, and their core thesis revolves around the structural fallout from the Fusaka upgrade.
The Fusaka upgrade, implemented back in December 2025, was lauded as a monumental technical achievement for the Ethereum network. It was a core protocol upgrade explicitly designed to scale network capacity and drastically reduce transaction costs for end users.
It was supposed to fix the gas fee problem.
And technologically, it was a massive success.
Yep.
But economically, it triggered a devastating cascade.
What's incredibly counterintuitive about the Fusaka upgrade is that by succeeding technologically, it actively harmed Ethereum's tokenomics. Under the EIP 5059 protocol rules, Ethereum's primary value accrual mechanism is the burn.
A burn, right.
A portion of every gas fee paid is permanently destroyed. That makes the asset deflationary when network demand is high. But by driving gas fees to near zero, the burn rate plummeted.
It's the classic paradox of scaling an infrastructure network. Think of it this way. You build 50 new lanes on a congested toll highway to increase throughput.
Okay.
But if you simultaneously drop the toll from $5 to 5 cents, the highway authority suddenly lacks the revenue to service its debt, regardless of how many cars are driving on it.
The revenue collapses.
Exactly. The Fusaka upgrade created a massive structural oversupply of cheap block space. There is now so much excess capacity that the gas fees, which are the protocol's core revenue engine, have absolutely cratered.
Koper's report argues that this excess capacity permanently crippled Ethereum's deflationary tokenomics. But they go much further than just critiquing the burn rate.
Oh, this is the wildest part of the report.
Yeah. Tom Lee and the Ethereum bulls point to the constantly rising number of active wallets and daily transactions as undeniable proof of mass global adoption. Koper dropped an absolute bombshell of on-chain forensic analysis. They claim their data proves that 95% of new Ethereum wallets are entirely fake.
That 95% metric is a devastating accusation. They're asserting that the primary growth metrics the market uses to value the network are an artificial illusion, heavily manipulated by malicious on-chain activity. Specifically, Koper's forensics isolated massive clusters of address poisoning and wallet dusting attacks.
Address poisoning.
Yep.
Koper is looking at the on-chain data and identifying massive automated bot networks. These bots are scraping user transaction histories and dusting lookalike addresses to hijack payment flows.
It's so insidious.
The trap is incredibly sneaky. A scammer generates a vanity address that perfectly mimics the first and last characters of a wallet you frequently interact with. They send a microscopic fraction of a cent to your wallet. That effectively injects their malicious address into your recent transaction history. The next time you go to transfer significant capital, you visually verify the familiar characters in your history, you copy the poisoned address, and you irrevocably send your funds to the scammer.
And the critical element here is the economic viability of that attack vector. Prior to the Fusaka upgrade, deploying millions of these dusting transactions would have cost the scammers exorbitant gas fees, rendering the attack unprofitable.
The high tolls kept the bad actors out.
Exactly. But because Fusaka drove block space costs to near zero, it fundamentally altered the economics of network spam. It became highly profitable for malicious actors to deploy automated botnets, executing millions of these microtransactions an hour.
That is the crux of Koper's short thesis. They are arguing that the network is not experiencing a golden age of human adoption. Rather, it is suffering from a plague of automated spam bots exploiting hyper-cheap block space, artificially inflating the network metrics.
Drawing on this data, Koper draws a brutal historical parallel. They compare Ethereum to doomed legacy tech giants. They label Ethereum the next Netscape or a Nokia, a first-mover pioneer that dominated early market share, but is ultimately collapsing under the weight of a structurally flawed economic model, while agile competitors capture the actual user base.
We are looking at an incredible collision of macro narratives here. Tom Lee models an environment identical to 1971, where regulatory clarity crowns Ethereum as the new global settlement layer. Conversely, Koper Research models a dying network cannibalized by its own scaling upgrades, overrun by spam, and losing vital institutional volume to alternative chains.
Right.
To determine how the market is resolving this tension, we have to analyze the financial reality. We have to look at the scoreboard, which is the equity performance of BMNR.
The volatility profile of BMNR stock is staggering. It represents the extreme beta of the asset class. Throughout 2025, as management broadcasted this massive Treasury pivot and began aggressively accumulating Ethereum, the equity went parabolic.
Yeah, the stock rocketed upward 248%. It established itself as one of the most heavily traded, high-momentum plays on Wall Street.
But gravitational market forces inevitably took hold. Since that peak, the equity has suffered a catastrophic 80% drawdown.
80%.
It is currently oscillating in a highly volatile illiquid range between $19 and $31, and the fundamental earnings reports provide the bleak context for that repricing. In Q4 of 2025, BitMine reported a positive net income of $333 million.
Right.
However, by Q1 of 2026, the structural volatility of their balance sheet manifested. They reported a staggering multi-billion-dollar swing, posting a net loss of $5.2 billion.
$5.2 billion. This violently introduces one of the most dangerous dynamics in corporate finance, negative alpha.
Negative outcome.
Based on current market capitalization, BitMine is trading at a severe structural discount to its net asset value. If the company holds $10.3 billion in verified liquid assets on the balance sheet, theoretical market efficiency dictates the corporate equity should be valued at or slightly above that $10.3 billion mark.
In a frictionless, perfectly rational market, yes. But capital markets are driven by risk premiums and institutional trust. Negative alpha indicates that the equity is actively underperforming the exact assets it holds in reserve.
The market is discounting the management.
The institutional market is analyzing BitMine's balance sheet and communicating a very clear message. They are saying, we verify you hold billions in Ethereum, but we fundamentally do not trust your corporate governance, your capital structure, or your risk management enough to value your equity at par.
That lack of institutional trust stems directly from the mechanics we unpacked earlier. The primary driver is the sheer terror of unbounded share dilution. When a board authorizes 50 billion shares specifically to acquire a volatile asset, institutional investors model that as a perpetual overhang.
Exactly.
They know that any significant upward momentum in the BMNR stock price will likely be met by management aggressively dumping new shares onto the secondary market to raise more fiat for Ethereum purchases. That constant threat of dilution creates a permanent structural ceiling on the equity valuation.
And the secondary driver is extreme risk aversion regarding the underlying asset volatility. That $5.2 billion Q1 loss is predominantly an unrealized paper loss. It's driven by mark-to-market accounting rules, reflecting the interquarter drawdown in Ethereum's spot price.
It's an accounting loss.
However, it vividly demonstrates the existential risk to the balance sheet. If Ethereum enters a protracted, multi-year bear market, BitMine's corporate equity is effectively wiped out. Institutions are demanding a massive risk premium, a steep discount to NAV to absorb that structural corporate risk.
However, we cannot analyze BMNR's equity performance or Ethereum's tokenomics in a vacuum. BitMine's ultimate survival isn't solely tethered to the success of the AMAD infrastructure or the Mr. Beast partnership. It is inextricably linked to the massive grinding gears of the global macroeconomic system. We have to overlay the macro liquidity picture.
This raises the ultimate variable, the global cost of capital. We are modeling a macroeconomic environment in 2026 where the Federal Reserve is aggressively shifting monetary policy. Consensus estimates project significant structural rate cuts, targeting a revised federal funds range of 3.5% to 3.75%.
The mechanics of central bank rate cuts are straightforward. When the risk-free rate of return drops, borrowing costs plummet, and liquidity flushes into the global system. Clear Street executives have publicly identified this exact monetary pivot as the primary macro catalyst required to trigger the return of massive retail and institutional liquidity to the digital asset sector.
The behavioral economics here are well documented. When the Federal Reserve cuts rates, the yield on safe fixed-income vehicles like short-term treasuries or money market funds, they collapse. To maintain their required rate of return, portfolio managers and retail investors are systematically forced to migrate further out on the risk curve.
Hunting for yield.
Historically, that displaced capital aggressively hunts for high beta, high volatility assets. A globally accessible, mathematically scarce digital asset class like cryptocurrency is perfectly positioned to absorb that tidal wave of structural liquidity.
So a dovish Federal Reserve could fundamentally bail out BitMine's aggressive accumulation strategy by orchestrating a macro environment flush with cheap capital. But the U.S. macro picture is only half the story. There is a severely destabilizing macroeconomic event currently unfolding in Asia that directly impacts global liquidity flows.
Yes. The abrupt systemic collapse currently playing out in Japan's sovereign bond market introduces a massive, unpredictable wildcard into global finance. Bank of Japan has spent decades managing an incredibly fragile, hyper-financialized system through yield curve control. We are now witnessing that control fracture, resulting in a violent spike in Japanese sovereign yields and extreme destabilizing volatility in the yen.
To connect the dots for you listening, a sovereign bond crisis in Tokyo has a direct, quantifiable impact on an Ethereum treasury company operating out of Las Vegas. The mechanism is capital flight.
Exactly.
If you are a massive Japanese pension fund, a corporate treasury, or a high net worth individual, and your domestic sovereign debt is structurally failing while your fiat currency violently depreciates, you are forced to execute defensive capital flight. You must find a safe haven.
Historically, that capital would aggressively rotate into U.S. Treasuries or physical gold bullion. However, the modern financial architecture offers a new release valve. Increasingly, sophisticated global capital allocators are modeling major, highly liquid cryptocurrencies as the ultimate non-sovereign hedge.
A non-sovereign hedge.
Ethereum represents a decentralized asset class that exists entirely outside the jurisdictional control, monetary policy errors, or sovereign debt defaults of the Bank of Japan or the Federal Reserve.
You have trillions in capital desperately fleeing the structural collapse of the yen, searching for a highly liquid harbor that isn't tethered to the balance sheet of a failing nation state. Suddenly, Ethereum, backed by a massive decentralized network and offering a native 2.91% staking yield through infrastructure like Maven, transforms from a speculative tech play into a highly attractive, synthetic, non-sovereign bond for terrified global capital.
This dynamic fundamentally alters the risk modeling. A severe liquidity contraction and bond market failure in traditional legacy markets could, paradoxically, trigger a massive defensive influx of capital directly into the crypto ecosystem. Bitmain's hoarding strategy is highly leveraged to this exact macro dislocation.
So, what does this all mean for you? If you are managing risk, allocating capital, or simply trying to comprehend the architectural shifts of the global economy in 2026, Bitmain Immersion Technologies represents the ultimate high-stakes test case.
It perfectly encapsulates the violent structural tension of our current financial era. On one side of the ledger, Tom Lee's thesis could be spectacularly validated. Bitmain may well be the vanguard of a brilliant, hyper-efficient corporate treasury model.
The bulls win out.
Right. They're actively utilizing Web3 base layer infrastructure, generating hundreds of millions in native protocol yield, executing strategic infrastructural partnerships with the largest media conglomerates on Earth, and aggressively positioning their balance sheet as the foundational settlement layer of a fully tokenized Wall Street. If global central banks aggressively cut rates, injecting liquidity in the Ethereum supercycle materializes, their alchemy of 5% strategy will be recorded as one of the greatest asymmetric bets in corporate history.
On the other side of the ledger, the forensic data provided by Andrew Kang and Culper Research paints a terrifying picture. Bitmain might simply be a heavily diluted, structurally flawed house of cards. They could be aggressively hyperinflating their float to hoard an asset whose technological dominance is rapidly decaying, relying on network adoption metrics artificially engineered by malicious botnets, and facing an institutional market that actively punishes their equity via severe negative alpha. A localized macro shock or a sustained crypto bear market could instantly unravel this multi-billion-dollar experiment, incinerating shareholder value.
The parameters of this experiment are pushing the absolute boundaries of corporate finance. They are aggressively stress testing the legal, financial, and structural limits of what a publicly traded entity is permitted to execute in the open market.
And that leads us to a final provocative thought, something we haven't explicitly analyzed today, but which fundamentally underpins this entire structural shift. The foundational premise of cryptocurrency, the core ethos of Ethereum, is absolute decentralization. It was engineered to be a neutral settlement layer, owned by the collective and controlled by no single entity. But if a single, highly centralized, publicly traded corporation successfully utilizes fiat capital markets to corner and control 5% of that entire global network, does the concept of decentralization survive?
It's the ultimate paradox.
At what specific threshold does a corporate entity cease being a mere participant in a digital economy and effectively become the central bank of its own sovereign digital nation? If Bitmain successfully executes the alchemy of 5%, who truly controls the settlement layer of Wall Street?
It is a profound structural question that directly challenges the architectural integrity of the entire Web3 movement. How the market and regulators resolve that paradox will undoubtedly define the geopolitical and financial landscape of the next decade.
Thank you for joining us on this deep dive. The mechanics we explored today represent massive, complex systems violently shifting in real time. It is absolutely vital to look past the surface-level price action and rigorously analyze the structural plumbing beneath. Keep running the models, keep challenging the consensus data, and we will catch you on the next deep dive.